All right. Good morning, everybody. I'm on, right? Yep, I'm on. All right. Good morning, everybody. Got a nice little cozy crowd again this morning, and I found that was a good class on Tuesday. We have a nice. It's almost like a normal class, but then we just have a lot of people watching on video, so that's actually kind of cool. So, all right. As usual, a few announcements. I've been amazed at how long I spend with announcements in this course. Something that I've learned. I was just talking to. In fact, I was talking to the dean about this last night. In these large lecture capture classes, I spend about 80% of my energy and time on the logistics of the class, and about 20% on the content. It's really amazing. But anyhow, a few announcements. We had a real good meeting last night at the Young Investors Club. As you saw on your from what I said on Tuesday and what was on posted on Canvas, Raymond James came out and spoke to the club about I thought it was going to be more shop talk, but they were talking about careers at Raymond James. So it was actually the recruiting team that was out there, and they gave a real good presentation. A couple of things jumped out at me. One of which was this. Now this is a picture that I took from like over there, so that's why it's all cockeyed on the screen. But these are some of the characteristics that they are looking for in potential employees at Raymond James. And a couple of them jumped out at me with respect to this course. Well, actually, several courses, one of which is writing. Okay, that's why if you'll recall on my syllabus, and we talked about this the first day of class, when you email us, regardless of whether it's me or my TAs, because when you're emailing TAs, you're emailing me, that's one of the main reasons why I require the emails to be in formal language. Okay, so you address it, you reasonably, grammatically correct, so forth and so on, okay? That's one of the reasons right there, all right? So that jumped out at me. What really jumped out at me was critical thinking and problem solving. Because somebody, I don't remember who it was, but it was someone down here last time asked a question, and the more I thought about it, I thought it was a good question and an interesting question, because we were talking about something on Tuesday, and I don't remember what it was, but it was something, something is affecting ROI or something. I don't remember what we were talking about, but the question was, the question was basically, how are we supposed to know that? Is it just supposed to be intuitive? Okay, that was the question. And the more I thought about it, the more I thought that was an interesting question. Because the answer to that question is, in the beginning, when you're first learning it, no, it's not going to be intuitive. Okay? But the point is to think it through. All right? Because that's what, in class we're always, whenever we're looking, whatever it is we're doing in here, you'll notice that I'm always saying, well, how would that affect net income? How would that affect assets? So forth and so on. Okay, so you have a particular transaction, and in the beginning, when you're first learning it, it's not going to be intuitive how that transaction is going to affect the debt ratio. Okay, but the point is to think it through. All right, well, this transaction lowers earning. Earnings are going to go. Expenses are going to go up, so earnings are going to go down, and liabilities are going to go up, or whatever. So I know that, and then I know that the debt ratio is total debt divided by total assets. So then, if liabilities are going up, then debt ratio would go up. Okay? So in the beginning, that's not going to be intuitive. All right? After you've done that 100 times, it'll be intuitive. Okay? Not that you do homework 100 times, but my point is, the more familiar you are with it, then it becomes intuitive. And that's what you're doing here, is building up intuition as decision makers. As decision makers, that's what you're doing, is building the intuition of, well, if this is the accounting choice that's made, I know that that's going to affect the information in this way. And that's either good or bad. And if others don't know that, then we will make superior decisions to them. Okay? So that's what this is all about. Okay, so like I said, that was asked last time, and the more I thought about it, the more I thought it was not only a good question, but an interesting question. And this is what jumped out at me last night, in addition to some other things. So good presentation last night, which also brings me to the extra credit assignment. There were a lot of you all there last night for your extra credit. and I think there's a little bit of confusion on the extra credit, so let me try and add some clarity here. Number one, you can go to any Young Investors Club meeting to get your extra credit. So last night was not your only opportunity to do that, okay? I mean, you can go to any club, and that's what I was saying earlier. I would advise you not to wait, because when the holidays start getting closer, they start getting a little more, they start canceling meetings and things like that. So I would suggest going earlier rather than later. Also, there will be some other opportunities during the semester. In fact, Kelly has a list of a few. We need to post those pretty soon. So hopefully we'll get those posted in the next couple of days. But we've already identified a few other things that we're going to offer for you to come to for extra credit. Because the club meets Wednesday nights at 7. And I understand that not everybody, you might have class or something. So I understand that not everybody can make it at that particular time. So we'll have a few other opportunities popping up during the semester. But listen, you got to meet me halfway on this, all right? I mean, the reason I'm giving you extra credit is 2 reasons. Number one, to help out your grade. Number 2, to help you understand, and I had a lot of good feedback about this last night. In fact, 2 girls in particular were backing up this last night. But there are a lot of opportunities here on campus for you. Okay, they're there for you. I don't need to join the Young Investors Club. I love working with a club. Okay, I don't need to join the Young Investors Club. Okay, they're there for you. Okay, and that's the point of this, all right? But what you got to do is, Kelly's already posted the extra credit form on Canvas. You need to print that form and bring it with you, okay? I had a few people last night, I forgot to print the form. Do I need to print the form? Can I just put it on a piece of paper? Look, guys, it's not, meet me halfway here, all right? It's not hard. Print the form and just bring it with you, all right? They have a stamp, they'll stamp it, you turn it into the TAs, and you're good to go, okay? So, I'm doing this to help you out, help us out. Just print the form and bring it with you, all right? So anyhow, and the extra credit, let's see, what else was I going to say about that? Investors Club, I guess that was it. Okay, so extra credit. I actually was able to get ahead a little bit this week. My other class, there's an exam in there, so I had a little bit of extra time. I think I have all the homework assigned going up into the next exam, going up into exam 2, because I think I've been able to forecast pretty well how far we'll get in each class. I may have to tweak the dates a little bit, but I will not move the due dates up. I may delay assigning them if we don't get as far as I thought we would, but most of those should already be on there, so we're good to go on that. Extra credit I talked about. We are in the process. Have we posted the grade calculator yet? No, because we're almost done with the grade calculator, so that should be posted on there probably in the next day or 2. So that should be on there pretty quickly. I also, not that this is a huge concern to you, but just an FYI, I'm doing some experimenting with the McGraw-Hill rep on getting the Connect grades into Canvas. So that may actually be in there sooner than I had anticipated, but we'll see. But in any case, and Kelly was working on the grade calculator. It looks really good too, so you'll be impressed with her Excel technique. So we should have that on there. Okay, like I said last time. I know what I was going to say. Getting back to what I said at the beginning about the critical thinking and all that. That's also part of the homework. That's part of the point of homework, is to go home. Well, here's the transaction, and how does it affect things? Okay, the point of that isn't to try and grab a couple of points to get a grade in the class. The point is to give you exercises to think through the logic, okay, of how it goes. And if you do that, then you'll get a better grade on the exam, okay? If you just treat the homework like a video game, then really you're double putting yourself in a bad situation, okay? Because you're not learning homework, and then you're not going to do well on the exam. Okay, so that's a big part of the point of the homework, is to help you, give you the vehicle to think through the logic of how the transactions affect the information that we use as decision makers. Okay, so with that in mind, chapter 7's a whopper. So we're going to start chapter 7 today, and there are lots of things to talk about. And there's somebody over here last time asked something about, does exam 2 have more math in it? And I don't view exams that way, okay? I test you on what we're talking about. I don't really pay attention to how much math and all that kind of stuff's on there. But looking a little bit more closely at chapter 7, I would now say, yeah, probably. Okay, so chat. Make sure that you're studying chapter 7 ahead of time. We're going to talk about some present value calculations today. Make sure if you've had business finance, if you've had 3403, then you're good to go on the present value calculations. If you have not, make sure that you look at that before Tuesday. Okay, because if you don't, when we get to long-term liabilities, you're going to be completely lost. All right, so make sure you look at that. I've posted several videos that I made. They're like a minute, 2 minutes long, something like that, showing you specific calculations. Like I said, I'm going to go through some of it. I'm going to go through it today in class. Make sure you look at the videos. Also, I have posted on there what I call interactive spreadsheets. Okay, and these are, this is an example of one right here. Okay, and they all work the same way, and it's like the algorithmic homework in Connect, where it'll give you a problem. Okay, and what you should do is pull out your calculator, work the problem under exam conditions, and then if you hit page down, the answer's down here. Okay, and what you can do, and for some reason it's not working on this computer, I do Y, and I don't know what that's all about. Did I just mess you up, Marie? Okay, I have no idea. I don't know what's going on up here this morning. But with normal Excel software, if you hit F9, it'll generate another random problem. Okay, and the answer will be random as well. So you can sit there and hit F9 all night long and practice the problem, and you get different problems all night long, okay? Occasionally, on these interactive spreadsheets, and I did these myself, by the way, occasionally somewhere in here, you'll see an error message that says something to the effect of, this is not a good problem or something like that. If you get that, just hit F9 and move on again. The reason for that is because I'm using a random number generator to generate the problems, so you guys know that most of the numbers are going to be here, but sometimes you'll get a number that's way over here or way over here, and it generates a unrealistic problem, if not a flat-out stupid problem. Okay, so if you get that error, just hit F9 and move on with life and don't worry about it. Okay, but my point is on the present value stuff, we need that tool to understand how liabilities are presented on the financial statements and to understand the implications of the different ways that liabilities are presented on the financial statements. So make sure, in addition to what we do today, make sure that you look at the videos that I have on there. Make sure you work with the interactive spreadsheets that I have on there. Make sure you read the book, but the issue here is the book, and I can't believe this, but the book still uses tables to make these present value calculations, and that's a little imprecise because of rounding. All right, so we're not going to use the tables. We're going to use the calculator, which is what you do over in 3403. So again, if you've had that, then you already know the stuff. If you haven't had that, then this is a good intro that'll help you out when you do get over there. So you can look at it either way. Okay, so just make sure that you are aware of that. And let's see, did that get it all? Extra credit grade calculator. Yeah, make sure you do the present value. Oh, the Chapter 6 homework, I split it up into two parts. One is Chapter 6 on the liabilities, which is what we're talking about. The other is Chapter 6 of present value. Okay, there's only 3 problems, I believe, in the homework for Chapter 6, the time value of money. There's only 3 problems on there. But before you do that, do this stuff. Okay, so before you do that, make sure you look at my videos. Make sure you can, do these, do these problems. And if you do that, you shouldn't have any problems getting the 10 points on that homework assignment. Okay, and I think that's it. And I don't have the energy to do these standard announcements today. So look at all the other videos for that. I was up late with the Young Investors Club last night, so I am dragging this morning. So if I start drifting a little bit, cut me some slack. Yeah. Yeah, the extra credit form is posted on Canvas already. It's under announcements. There's an announcement. The title of it is, I believe, extra credit, and it's on there. So just print it and take it with you. Yep. Okay. Other questions? Other questions? Going once? Twice? Okay. Yeah, the dean of the college actually came to the Young Investors Club last night, and I had a chance to talk to him quite a bit, and the subject of this class, in other words, you all came up. So your ears were burning last night. Okay, then let's go ahead. We need to wrap up chapter 6. I think I just said chapter 6 instead of chapter 7 a minute ago. But anyhow, we need to wrap up chapter 6, which won't take too long. We were talking about long-term assets. We were talking about cost recovery of long-term assets. Make sure that you understand that on the exam, I am going to test you on more than just depreciation. So I'm telling you to expect amortization on there, and I'm telling you to expect depletion on there. Okay, that's one of the main points of this course. You all talked about depreciation in the principles courses. Well, we're moving beyond that. Okay, there's also amortization on the financial statements. I've shown you that. Now, often not depletion, but again, if they have natural resources, there is. So I'm telling you, amortization, depletion will be on there. Okay, which is also why it's on your homework. So you have a few homework problems on that as well. Okay. All right. So the last part in chapter 6 is it amazes me. I get here at like 10 till 8. And I think I have all this time to get ready for class, but by the time students come by and ask me questions, and TAs come by and ask me questions, and colleagues come by to tell me whatever's going on, I like run out of time. So I'm gonna have to start getting here like 6 in the morning or something. But anyhow, okay. The last little section on here is a very common accounting issue, and it's a hot issue because sometimes you'll see this in some financial statements that I have. You may have at some point in time or another in your financial conversations heard the term off-balance sheet financing pop up, okay? And one of the ways that happens is through lease agreements, okay? So what we're talking about here is a company, and the financials that I have for you are JetBlue, okay? So I'm going to show you that in a minute, JetBlue Airlines. JetBlue obviously has a lot of aircraft, okay? Some of those aircraft they own, some of those aircraft they lease. Okay. And that's going to affect the information that we use to make decisions, particularly our ratios, particularly our leverage ratios. Okay? Because you guys know or should know by now that the higher the leverage ratios, debt to equity and debt ratio, the higher those ratios, what's the implications of that? Final exam review. Actually, every exam review, but particularly final exam. Higher debt to equity ratio or higher debt ratio, why do we care about that? Outstanding, because it indicates more risk, okay? Because there's more debt, all right? Well, one of the ways that they can avoid that is through a lease agreement, okay? Because think about it, if you lease a car, okay, you have a lease agreement, but you haven't financed anything, all right? So there are two types of leases, operating lease and capital lease, and the difference has to do with the issue is substance over form, okay? And this, by the way, that's an important concept in any accounting discussions, and particularly any tax discussions, okay? The substance of a transaction is much more important than the form of the transactions. One of my CPE instructors one time told us that, you know, if you have something and it has feathers and webbed feet and it likes to swim in the water and it quacks, just because you hang a sign around its neck that says cow doesn't make it a cow. Okay, it's a duck, all right? And that's kind of what's going on here, because if a company, the gist of this is if the transaction in substance is purchasing the asset, then it's a capital lease and needs to be treated as a purchase rather than just a lease, okay? So, getting a little more specific, an operating lease is when we first talk about leases, this is what probably pops into your mind, okay? You're going to go lease a car, all right? Well, you lease a car, you don't own the car, okay? The title is not in your company's name, all right? So what you're going to do is you're going to take possession of the car and you're going to pay lease payments every month of $500 a month, let's say, and every month on the financial statements, in the income statement, you're going to have an expense of $500 a month for lease expense, and that's it. Okay, nice and clean. All right, that is an operating lease. Okay, so they're saying ordinance for use of assets does not involve any attributes of ownership. Okay, so that's your typical lease arrangement. However, if and notice that in that arrangement there would be no assets and no liabilities. So let me do it this way. All right, depletion. Yeah, we talked about all that. Depletion. Okay. All right. I want to, hang on, I'm getting there. Oh, because I want to do this. There we go. All right. Which, by the way, is why I don't do the full screen in the first place, so that I can do things like this. All right. Review that. Pen, blue. See, I'm getting the hang of this. All right, we'll get there. By Christmas, we'll be good to go on this, okay? So, all right, so operating lease. That's what I get for shooting my mouth off. What the heck?
You need to get rid of the text box.
I need to get rid of the text. I don't think that's bothered me before.
Hit the border.
Border.
Delete.
There. Oh. I've never done that before. No. All I want to do is write on the board. All I want to do is write on the board. I wish they would just put a whiteboard in here. All right, one last time, and then I'm going to move on. So eraser, I know that's not right because we're erasing. So we do that. I am flipping out because I have no idea what the heck. Okay. Actually, you know what? I'm going to do it this way. Yeah, probably. Yeah, throwing it around, I probably did. You have any paper with you? Yeah. Give me a piece of paper. My TA is saving me here. All I want to do is write on the board. That's all I want to do. Thank you. Do you have an extra pen? I really don't care as long as it writes.
The pencil pens haven't worked out yet.
Yeah. Thank you so much. All right. Yeah. All right. What are we talking about? Operating leases. Okay, so leases. All right, so if it's an operating lease, then the only thing that's going to, it's just like leasing a car. Okay, so you go get the car, you make your lease payments, and that's it. All right, so the only thing that's going to happen under an operating lease, and let me know if this kind of gets off and you can't read it. So under an operating lease is you're going to have lease. Oh, Marie's messing with the computer back there. Lease expense and then cash. Okay, so let's say that you're just paying $500 a month. Okay, so this is the only thing that's going to happen. Nice and clean. But notice that you have use of that asset, right? But it's not popping up on the financials. Okay, so it's not popping up under assets. It's not popping up under liabilities like it would if you purchased it. Okay, because if you purchased the asset, then as you know, you're going to have, I think we were talking about a car, okay? And let's say that you financed it, all right? So you've got a car and you finance the purchase, okay? And then you're going to have interest and cash, let's say, or interest payable, whatever, okay? On the loan, okay? And then because you own the car, you're also going to have depreciation expense and accumulated depreciation. Right? Okay. So notice that if you own the car, you got your expense, which you're also going to have up there, but your assets are being affected and your liabilities are being affected. And I think it would be fair to say that most of the time, I think this is a fair statement, most of the time that companies are seeking off-balance sheet financing arrangements is to keep the debt off the books for the reasons that we just talked about. Higher debt, more risk. Okay? So if you purchase it, you're going to have that on there. If you lease it, generally speaking, then you won't. Okay? So the trick is, well, why don't we arrange the lease terms such that really we own it, but we're calling it a lease? Does that make sense? That's the game. That's what you would try and do, right? Okay? And that's what led to the accounting rules for capital leases. Because if that's what you're doing, then it's no longer an operating lease, it's a capital lease because the substance of the transaction is that you're purchasing the asset. You're not leasing it at all. For example, this car that we're talking about, that you have leased the car, okay, let's say that at the end of the lease term, you have the option of purchasing that car outright for $1. Who would not do that? Nobody. Everybody would do that. It's called a bargain purchase arrangement. Okay? Everybody would do that. Therefore, even though you're calling it a lease, the substance of the transaction, you bought the car. You bought the car and you financed it. Okay? And if that's the case, then the accounting for it, so this is the accounting under a capital lease agreement, would really be the same thing as purchasing it, except instead of a note payable, it'd probably be called like a capital lease obligation. Okay, and the accounting for this actually gets a little sticky. In fact, Kelly and I were talking about this over the summer when we were looking at this. We were looking at some of the I take that back. It was Zhao. We were looking at some of the details of this, and the actual accounting for it gets very detailed, which we're not going to get into because this isn't an accounting class. But the gist of it is that under a capital lease arrangement, you would do essentially the same thing that you're doing as a purchase, which is to say you'd put the car on the balance sheet. Okay, you would have, instead of note payable, you'd have a capital lease obligation is probably what it would be called. Okay, you're going to have to, or the company's going to have to impute interest on that capital lease, which, by the way, is another reason why calculating present value is important, which we're getting ready to do in a few minutes. Okay, so it's related to those calculations. And then you're going to depreciate the asset as if the company owned the asset. Okay? So whether a lease is an operating lease or a capital lease is important because it's definitely going to affect not only assets but also liabilities. All right, make sense? Yeah.
So let's say under a capital lease, at the end of the term, you have the option of buying it, but you choose not to buy it.
Uh-huh.
At the end of the
If you, I mean, that's a good question. If you chose not to buy it, then it would be disposition of an asset like we talked about before. You know, and I guess you'd have gain or loss on there and so forth. Yeah. Yeah, and again, I mean, that's a fair question. Now, if you can buy it for $1, why you wouldn't do that, I don't know. But if for whatever reason you chose to do that, generally it would be like disposition of an asset. There probably, given that it's a capital lease, there are probably some little accounting intricacies in there that I'd have to look up. But that would be the gist of it. Okay. Okay. And was there one back? Yeah. Well, I would either on the exam tell you that it was operating or capital lease, or you would have to make that determination, which I'm getting to in just a second. So hold that thought for 1 second. Yeah. Yeah, and I think I have the answer to both of those in just 1 second. Okay. Yeah. Okay. Yes. Yeah. So a capital lease is essentially accounted for the same way as a purchase. Like I say, the only difference, well, for our purposes, the only difference would be instead of a note payable, you'd have like a capital lease obligation. They'd call it cap, and you'll see that in JetBlue in just a second. Okay? Other questions? Okay, and with these two questions here, we're talking about capital leases. These are the criteria that the standard setters use to dictate whether a lease is really an operating lease or a capital lease. Okay, so these are the criteria. You should be familiar with these criteria. I mean, you don't have to, you know, I'm not going to drill into every single little detail of all this, but you should be familiar with this. Noticing the common denominator is that with all of these, even though it's being called a lease, the substance of the transaction is the company bought it. Even though they're calling it a lease, really, they bought it, okay? For example, at the end of the lease, if the ownership automatically transfers to the lessee. Well, what's the difference between doing that and financing it? Nothing. I mean, in substance, nothing. Okay? So that would be a capital lease. Bargain purchase, I just told you about that. Okay? So to answer, and I forget which of you asked this question, but if I get on the exam, and say, hey, you've got such and such, you leased it under such and such, and, you can buy it at the end for $1, how would, debt be affected, or, something like that, okay? Well, you should know that that would be a capital lease, okay? So that's one of the ways, that's one of the ways right there. Okay. Lease term greater than 75% of life, and the present value of lease payments greater than 90% of the fair value of the asset. So that gets a little more technical. But again, the common denominator of all this is that if one, and by the way, they only have to meet one, but if one of those is satisfied, then the substance of the transaction is they actually bought the asset. It's not a lease at all. And therefore, they need to account for it as if they had purchased it. Okay? Questions? Very important accounting issue. You see that often. For example, and where are my? Oh, where the hell? Oh, hang on a minute. Hang on. Hang on. Meditate on those capital lease terms for just a minute. Where are you? Where are you? James, I've got that. Oh, there it is right there. All right, don't go away. Don't go away. There we go. Okay. All right, for example, JetBlue. Okay, so this is I pulled up some portions of JetBlue's annual report. So if you're watching this on video, then what you want to do right now is hit pause, Google JetBlue 2014 annual report, and it'll bring you to this. Okay, so with JetBlue, just showing you a real-world example. Okay, so let's see, they've got where is it on there? Here we go. Okay, so one of their tables in the notes, notice that they're listing the aircraft that they have, and they have 137 that are owned, 6 that they have under a capital lease agreement, and then 60 that are under an operating lease agreement, being reminded that these 60 that are under operating leases aren't going to be on the balance sheet. That's just going to be the lease expense and then cash or payable or whatever, and that's it. Okay. So JetBlue apparently has, well, not apparently, they do have quite a few capital lease arrangements. They talk about that right here. Notice that they have a little section on here on what I said at the beginning of this, which is off-balance sheet arrangements, and the very first thing. Okay, and this might be a little hard to read, so I'm not going to read the whole thing to you. None of our operating lease obligations. Okay? Make note of that. Okay. Again, operating leases, there's still an obligation there, but it's not popping up under liabilities. Hence, off-balance sheet financing. Okay. None of our obligations are reflected on our consolidated balance sheets. They don't have to tell us that because we already know that. Okay, but they're just making it clear. And then so forth and so on. Okay, they go on to talk about their arrangements, why they're doing it, and so forth. Their assets. So these capital leases would be listed. Be aircraft. So it'd be under their aircraft in here, wherever that is. So the capital lease arrangements would be in there. The aircraft that they have under operating leases would not be listed in there. Okay, and noticing while we're on the subject, where is it? Actually, I guess it's not on this page. Strike that. They got accumulated depreciation, so forth and so on. Notice under the liabilities section, okay, long-term debt and capital lease obligations. Okay, so those capital lease agreements are increasing debt and increasing assets. Okay. All right, so real world example of that. On a side note, we talked about this a little bit before. We're going to talk about it quite a bit in chapter 8. But just on a side note, notice the equity section. So we have our standard common stock, additional paid-in capital, retained earnings. Notice they also have treasury shares, preferred stock, and notice they also have accumulated other comprehensive income. Okay, we talked about that before. We'll be talking about that quite a bit again. Okay, so that's just a reminder there. And what else did I have on here? Yeah, their lease expenses for the operating leases would be in here somewhere. I'm assuming under other operating expenses, but I really don't know. But they're in there somewhere. Okay, and notice down at the bottom, earnings per share. Okay, which is why on many of your homework problems and in your exams, I'm asking you to calculate earnings per share because that's on every income statement. It's a required disclosure. Okay. All right, so that is the upshot of capital leases. Questions about that? Questions? Capital leases, going once? Twice? Okay. All right, you have some homework on that, so you'll see that. All right, the last part of chapter 6, I'm not sure why they put this at the end of chapter 6, but I suppose it's as good a place as any, is on time value of money. And this is just simply a tool that we need to understand to understand how long-term liabilities are accounted for. Somebody before class was asking me, well, something to the effect of, when do I need to know present value calculations? Well, we don't do them for short-term liability. So the first part of chapter 7 we don't, but the second part of chapter 7 with long-term liabilities we do. All right, so you got a little bit of time here, but you need to understand these calculations before we get into long-term liabilities, because if you don't, then when we get there, you'll be lost. All right. So here's how present value works. Again, if you've had 3403, then you should be all over this, but many of you have not had that. All right. So what I'm doing here, for those of you who have not had business finance yet, is I'm taking time value of money is a big subject, and what I'm doing is just carving out just the little piece that we need to know. Okay, so I'm not doing everything, just the little piece that we need to know. All right. So here's the short version of time value of money. Okay, time value of money is based on what's called compound interest. Okay, as opposed to simple interest. Okay, what's the difference between simple interest and compound interest? Yeah.
Simple interest is like when you're taking interest for like once per year, while compound is like either monthly or weekly or.
Close. Help me out. Muhammad, right?
No.
I'm sorry. Okay, go ahead.
Compounding is when it's compounded over a period of time, and it's added together. And the other one, what is the other one called?
Simple.
Simple is just when it's taken out of a whole.
Okay, close. Helps out.
Simple interest is like, it's the same interest. It's the interest on the initial investment. Like you
Right.
invest $100.
Right.
It's 6% of that $100 every single time.
Right.
Compound, it builds on itself.
Okay, close enough. Yeah, and I think all of you understand it. You just may not be saying it. Simple interest is when you receive interest only on the original principal. Okay. Compound interest is when you receive interest on interest. Okay, so you're receiving interest on not just the principal, but also on the interest itself. Okay. For example, right? Let's say. We'll keep the numbers simple.
Is this chapter 6 still?
This is the end of chapter 6. This is the end of chapter 6. Okay. Let's say that you're going to invest $100 at 10% compound interest for 3 years. Okay, 10% for 3 years. Okay. So 0, 1, 2, 3. Okay. So this is a savings account, let's say. Bad example, but some sort of account. So you invest $100. So at the end of the first year, how much interest will you have earned? This is and by the way, all of our time value of money calculations assume it's based on compound interest, not simple interest. Okay, so it's always, I don't use that word often, but it's always based on compound interest, not simple interest. Okay, so the first year, how much interest have we earned? $10. Therefore, at the end of the first year, we would have 110. Okay. Second year, how much interest would we have earned? $11, because we're earning interest from the beginning balance, okay? If this was a simple interest arrangement, then we would just earn $10 each year, okay? Because it's just the 10% on the original balance, okay, on the principal, okay? But compound, it's interest not just on the principal, but also on the interest itself, okay? So for the second year, 10% times 110 is $11 in interest. So at the end of the second year, we'd have $121. At the end of the third year, well, our interest for the third year rounded to the nearest dollar would be $12. We would have 133, and so forth and so on. Okay? So that's how compound interest works. Okay. So far, so good? Okay. Couple of things we can say here, all right, is that $100, if we invest $100 at 10% for 3 years, then the future value of that $100 is $133. Does that make sense? If we invest $100 for 3 years and we can get a return of 10%, then the future value of that $100, not the value today, the future value is $133. Does that make sense? Okay. More importantly for our purposes, we can also say that if we are going to receive $133 in 3 years, and the appropriate rate of interest is 10%, then the present value of that $133 is $100. Okay? So if we're going to receive $133 in 3 years, okay, that's an investment. All right, so we've invested in something. All right, we're going to receive $133. The deal is we're going to receive $133 in 3 years, okay, and given an interest rate of 10%, then the present value of that $133 is $100. That's what it's worth to us right now. Does that make sense? With me? Okay. Okay. That's important because this is how liabilities, long-term liabilities, are valued on the balance sheet. It's how they're recorded, basically, on the balance sheet. It's also a little intro to 34.3. It's also important because this is how we value any investment. It's how we value any investment. Okay? All right, questions so far while I catch up on my notes here. I'm used to teaching the whole full-blown version of this, so I've got to remind myself of focusing on just what we need to know. Questions so far? Yeah? Here? Periods. A period, yeah. Period. So period 0, 1, 2, and 3. So period time 0 is always right now. Okay, and then time 1, 2, and 3. Okay. Other questions? Other questions? Oh, yeah. Yeah. Okay. And since you bring it up, this is compound interest. What is meant by the term a compounding period? Not necessarily 12 months.
At what time period it's compounded? Could be monthly, quarterly.
Okay, a compounding period is how often we receive interest on interest, which is to say how often we are credited with the interest. Okay? In this problem, the assumption, because of the way the problem is worded, is it was annual. Okay? So notice that in this very simple problem right here, the $10 interest, we didn't receive that until the end of the year. Okay? So that was annual compounding. Right? Okay. If, for example, interest was compounded semi-annually. What does semi-annual mean? Twice a year. Okay. So if it was compounded semi-annually, then we would get credit for $5 of interest in 6 months, and we would start earning interest on interest at that time. Okay, very important concept, so that was actually an important question. Okay, that's what's meant by a compounding period. Okay, And we'll see that more in a minute, because what we're going to focus on in this course is either annual compounding or semi-annual compounding. I don't think we do any quarterly compounding. I'll hedge a little bit on that and say we might, but I don't think we do. I think we stick mostly to annual and semi-annual compounding in here. Okay? All right, other questions so far? Other questions so far? Okay. With that brief little intro, for the record, the calculation for this, which I'm not going to ask you the formula on the exam, but you should be able to work with this when you're studying at home, would be this right here. So the present value of a future cash flow of 1 is the future value divided by 1 plus r to the n. Divided by 1 plus r to the n. So in this case, that would be 133. The interest rate is 10%. 3 compounding periods. And if you do that with the exception of some rounding, you'll get $100. Okay. I beg your pardon? Yes. Yeah. R. Yeah. Specifically, R is what's called the periodic rate. Okay. And the periodic rate is how much is the rate of interest per compounding period. Per compounding period. So this is an important point, so pay attention. In this case, compounding was annual. So since that subject comes up, let's go ahead and address it right now. This is a very, very important point, so pay attention. Okay? In this case, compounding was annual. Therefore, the rate of interest is 10%, and the number of compounding periods is 3, once a year for 3 years. Okay? If compounding had been semi-annual, yeah, still have the 133, but if it was compounded semi-annually, then the interest rate would be 5%, because you're getting 5% every 6 months, and that would be 6 compounding periods, because you have 2 compounding periods per year for 3 years. Does that make sense? Okay. Make sure you understand in this, interest rates are always quoted annually. Interest rates are always quoted annually. So in a problem, if I say, it's 10% compounded annually, that means that you get 10% a year. Okay? If I say it's 10% compounded semi-annually, then that still basically means you get 10% a year, but more specifically, it means you get 5% every 6 months. Okay? It does not mean you get 10% over 6 months. You with me on that? That's a critical point, because you'll lose points on the exam if you don't understand that.
So technically it wouldn't really change the value, it just changes the period that you're acquiring.
Well, it would change the value because the math is different. So actually it would change the value a little bit. Yeah, which is what I'm getting at, because if you don't understand what I'm just saying, then you're going to pick the wrong answer, or you're going to calculate the wrong answer on the exam. Okay, so what was I going to say about that? Semi-annual, interest rates always quote, I know what I was going to say, is the reason interest rates are always quoted annually is so that we can compare them. Okay, if it wasn't that way, then it wouldn't be easy to compare the return of a 6-month loan to the return of a 30-year loan. We wouldn't be able to compare it. So they're always quoted annually for that reason. So whatever the rate is on the exam and in the real world, okay, whatever the rate is, that's an annual rate. That doesn't mean, if you invest in something at 8%, invest in a 3-month investment at 8%, that doesn't mean you're going to get 8% in 3 months. Okay? That's 8% a year. You're going to get 2% over those 3 months. Okay? All right. Other questions so far? Other questions so far? Okay. As much as it pains me to do this, I kind of have to. So I'm going to have a quick calculator class with you. I'm going to show you how to do this on your calculator. What I'm not going to do is I'm not going to get bogged down. I don't want to get bogged down in here on, well, I'm doing that, but I'm not getting the right answer. okay, because we'll spend the rest of the time doing nothing but that. And one of the few advantages of a lecture capture class is you can go back and roll the tape, okay? So go back and rewind. We're 49 minutes into the class, so you can make a note in your little notes right there. So fast forward to 49 minutes if you want, because I want to show you how to set up your calculator. And the key to this for our class, the key is to make sure your calculator's set up correctly. Okay, that's the key. I have everything that I'm getting ready to go over, I have videos on it on Canvas. Okay, so number one, everything that I'm getting ready to go over, which I'm going to go through rather quickly. Okay, number one, I have videos on Canvas. Number two, I have the interactive spreadsheets for you to sit there and practice the problems. And number three, you can go back to the lecture and rewind what I'm saying. Okay, so like I say, I'm doing that, so I'm going to show you how to do it, but I don't want to get bogged down in, so please don't raise your hand and say, well, I'm doing what you're doing, but I'm not getting the right answer. Okay, it's probably, if that happens, it's probably because you don't have the calculator set up correctly. Okay, that's probably what it is. Okay, so with that, again, this is I'm going to say it's a little bit unique to this class because in your other classes where you do time value of money, there are some calculator tricks that you can do, and I don't know how deep they get into that. For us, we're really only dealing with this in Chapter 7, so if you can kind of do it one way and you understand what's going on, then that's good enough for our purposes. Okay? All right, so there's a couple things that you want to do here. All right, first of all, you want to set your calculator up to 9 decimal places. All right, you want to be very accurate with these calculations. The way you do that at the bottom, if you look in the period, and by the way, over on the left, there are 2 shift keys. Okay, one is kind of a brownish color, the other is kind of a bluish or purplish color. Whenever I refer to shift, I'm always referring to the brown key. I never use the other one. Okay, so when I refer to shift, I'm always referring to the brown key. Okay, so the way you change to 9 decimal places is, and I take back what I just said, is in the shift part of the equals key. Okay, so if you look in there, you'll see it says display. It's D-I-S-P, display. That's how you change it. And I never remember the order because I only do this once a semester when I teach this. Okay. So if you hit, for example, 5 shift display, if you hit shift display 5, there's only 2 choices. You hit one first or the last, I'll get there. Okay, so if you hit shift display 5, you'll notice that you now have 5 decimal places. If you hit shift display 2, you'll notice that you now have 2 decimal places. Okay, change that to 9 and leave it there all semester. Okay, so shift display 9, you now have 9 decimal places. Okay, so that's the first thing. Second thing, and these are in no particular order, of course. The second from the top on the far right, you have a begin-end key. All right, and that's telling you what type of annuity it is, and we always want that on end. Okay, so in your screen, and I'm using a calculator version, so mine's a little bit different, but I think on yours, if it's in end mode, there will be nothing in your screen that says that. If it's in begin mode, you'll see BEG in there. You want to get rid of that, okay? So if you hit shift and that key, okay, then depending on what it's in now, you'll see begin pop up, BEG. If you hit shift and that key again, it'll go away. Okay, you want it to go away. Okay, so hit shift and that key until that goes away. Begin, end, second. It's second from the top all the way on the right. Okay, so hit that until begin goes away. Okay, and that's the way you want that. All right, the other thing we want to do is we want to set our calculator to 1 compounding period per year. Okay, and this is where you can actually do some calculator tricks. And if you know how to do that, that's fine. If you want to do it that way, that's fine. But for those of you who don't know it yet, we're going to do it one way and leave it at that. Okay, so what we want to do is we want to tell our calculator that there's only 1 compounding period per year. Okay, the way you know whether or not your calculator is set that way is by hitting clear all. Okay, not clear, but clear all. So if you look right below the shift key, in the shift area there, you've got clear all. okay? You always want to hit that key because if you don't, if you just hit clear, then, and I show you an example of this on one of my videos, if all you do is hit clear, sometimes there can be some numbers lingering around in your calculator, and then you get the wrong answer, okay? So you always want to hit clear all, okay? When you do that, when you hit clear all, you'll see a number pop up very briefly. That's how many compounding periods per year your calculator thinks there are, okay? What you want to do is you want to set it to 1. Okay, and the way you do that, up top, second from the right, in the shift area there, you see periods per year. Okay, so you want to change that to 1. So that is, so for example, if we hit, if you hit 5 shift periods per year, then when you hit clear all, you'll see a 5 pop up. If you hit 8 shift periods per year, then hit clear all, you'll see 8 pop up. Okay? You want to set that to 1. So hit 1 shift periods per year, and then when you hit clear all, you'll see a 1 pop up, and that's the way we want it set. Okay? And the last one is, clear all. Make sure you hit clear all. So did I get all those? 9 decimal places, begin, end, 1 compounding period here, and clear all. Okay, so that's how you want to set up your calculator, and for that matter, use your calculator. If you're working at home and you're not getting the right answer, a lot of times the reason is because you don't have your calculator set up correctly. Now in here, it shouldn't be too much of a problem because once you get it set up the way we just did it, just leave it that way and you're good to go. If you're doing these calculations in another class where you're changing that stuff, then you might have an issue. Okay, so all right, so now that we have it set up that way, okay, the way we would solve this problem on our calculator is the future value would be 133, okay, and we can put this in no particular order, so the order doesn't matter, okay. First thing you do before you do that is to hit clear all. Hit clear all. I had it when I teaching 34.3, I used to drill that in their heads, and about a year ago, I guess it was, I was walking back from the Union, and way across the street, there was a girl that had my class like a year and a half ago or something like that. But from way across the street, she said, you know, hey, Professor, hey, how are you? I had you for 34.3. I was like, yeah, that's great. She goes, clear all. I said, well, you know, I hope she learned more than that in the class, but I'll take a victory wherever I can get it, you know. But I thought that was way across the street. So anyhow. So clear all, future value 133, our rate, okay, and by the way, all of these keys are across the top row of the calculator, okay. The rate, which they have an I key. They have this key right here, interest per year, okay, but that's R, all right. So our rate would be 10, and you got to be careful here. I wish the calculator wouldn't do this, but it does. Be careful. Our interest rate in this case is 10%. So what you want to do is you want to put in 10, not 0.1. The calculator moves the decimal place for you, and I wish it wouldn't do that because it leads students astray in other calculations. I wish it wouldn't do that, but they didn't ask me, and that's the way it works, okay? So when you're putting in the rate, make sure to move your decimal place over. You put in 10, not 0.10. With me? Okay. All right. So you put that in there. In this case, number of compounding periods is 3, all right? And then hit the present value key, and with the exception of some rounding, you should get 100. All right, so I'm going to do that just to make sure. So clear all. So what it did was 133, hit future value. 10, hit the R key, the interest key. 3, hit N. Okay, if you want to make sure that you're okay, you can put in 0 and hit the payment key. All these keys are across the top row, and then hit present value. And it actually comes out to $99.92 because there's a little bit of rounding. There's a little bit of rounding in because we rounded the interest on that problem. Okay. All right, so that is the short version of how, and all, you know, in the other class you're going to calculate future values and all this kind of stuff. What we need to know in this class is calculating present value. Okay, because for long-term liabilities, that's one way that they are recorded on the financial statements. Okay, and it also affects the interest expense, which affects our ratios, so forth and so on. Okay, so see, I got that, and okay. So questions so far? Questions so far? You can put it in as a negative. If you put your payments in as if you put the future value in as a negative, the present value will come out as a positive, which is fine. I'm not going to get on the exam and give you two answer choices, one being positive 100 and one being negative 100. I'm not going to do that to you. Okay. Technically, well, in this case, we should put it in as a positive. When we're calculating the present value of long-term liabilities, technically they should be put in as a negative. But as long as you keep your signs correct, it's not gonna matter for it. And like I say, I'm not going to get on the exam and test you positive versus negative. Okay. Other questions? Other questions? I'm being serious. Okay. So the problem that we just did here was just one cash flow. Okay? Because all they're receiving is one cash flow in 3 years. All right? And that's what's called present value of 1. Present value of 1. Okay? The second type of cash flow that we need to be able to deal with in here is what's called an annuity. An annuity. Okay. And what is an annuity? Yeah. Okay, close enough. An annuity is equal cash flows over equal time intervals for a finite amount of time. Okay. Equal cash flows. So let's say, unlike the problem that we just did, let's say that we receive $100 per year, $100 per year, okay, every year for 3 years. Okay. Is that an annuity? Yes, equal cash flow, $100, equal time intervals every year, as opposed to receiving one in a year and another one in the next 3 months, another one in the next 9 months, that kind of thing, okay, for a finite amount of time. There's an end to it. It ends in 3 years. Okay? So, exam question, you have this annuity. We'll still assume a 10% interest rate just to keep the number simple. Calculate the present value. Well, with the calculator, it's very easy. And even with the formulas, it's not too bad. But with the calculator, it's very easy. Because essentially, we're doing the same thing. It's just that instead of using the future value key, we're going to use the payment key. All right. So to calculate the present value of this, and by the way, before I forget, 99% of the time, there's an important 1% exception that we're not going to talk about in this class, but 99% of the time, however frequent the payment is how frequent the compounding is. So even though I don't specifically say it's annual compounding, you know that because the payments are annual. Okay, so heads up on the exam. All right? So calculate the present value of this. So like I say, we're going to do it essentially the same way, except we're going to use the payment key instead of the future value key. Okay? So payment, $100. Still 10%, which we're putting as 10, not 0.1. And then still 3 years. Three compounding periods. 3 compounding periods. Okay? So we plug that in. Solve for present value like we just did, and what you will get, if I'm reading my notes correctly, is 248.69. 248.69. Yep, 248. Oh, I'm sorry. Yeah, 248.69. 248.69. Okay? It's called an annuity. So far, so good? All right. And one of the things that you want to kind of pay attention to in these calculations is you want to develop an intuition. All right. On the exam, if I asked you to calculate the present value of the first problem, okay, you're only receiving one payment of $100, so it wouldn't make sense that the present value of that is $248. That wouldn't make sense. So if that's what you did on the exam, you would know that you hit the payment key instead of the future value key. Okay. All right. So anyhow, all right. So next problem, same example, except now compounding is semi-annual. Okay. So more specifically, instead of receiving $100 a year for 3 years, you're going to receive $50 every 6 months for 3 years, and the discount rate is 10%. Okay, so $50, you're going to receive it $50 every 6 months for 3 years, and the discount rate is 10%. Calculate the present value. Well, the payment will be $50. Okay. The periodic rate will be, no, the periodic rate, not the number of compounding periods. It's going to be 5, because remember, interest rates are always quoted annually. Okay? Getting ahead for what we're going to do on Tuesday, that 10% is referred to as the annual percentage rate, APR. Very important term, APR. Okay? So the 10% interest rate's always quoted annually. So the question was, you're going to receive $50 every 6 months for 3 years, and at a discount rate of 10%. That's an annual rate. So the periodic rate would be 5%. Okay, that's how much you receive so that's the rate every 6 months. Okay. And then the number of compounding periods would be 6, because it's 2 compounding periods per year for 3 years. Okay, and again, you can put these in any order. The order you put them in doesn't matter. Okay. So when you do that, solve for present value, and you get 253.78. 253.78. Okay. Noticing that 253.78 is different than 248.69. Exam tip. Both of, assuming it's not, it may be a fill in the blank where you just got to simply calculate it and plug in what you get. Okay? But if it's a multiple choice question, both of those will be answers. Okay? And the reason is not because I'm mean and nasty and trying to fail you and all that kind of stuff. It's because this would be a big mistake to make when we take this and multiply it by the 5,000 bonds or 50,000 bonds that a corporation issues. That would be a big difference. Okay, which is also why we're not using the tables in the book. Okay, yeah?
Can you just change it to 2 periods per year?
Yes. If you know how to do that on a calculator, you can just change it to 2 periods and you're good to go. Yeah. Yeah, and here I'm giving them the shotgun version. So if you can do it one way, I'm happy in here. You can get fancy over in 3403. And you should, and you will. Okay. Okay. All right, last one. Combination of the two. Okay. So now, let's say that, in fact, we'll go ahead and do the full-blown version. All right. So let's say you're going to receive $100 every 6 months for 3 years. So far, so good? Okay. At the end of the 3 years, you're going to receive an additional $133, and the discount rate is 10%. Okay. Calculate the present value. Okay. So notice this is a combination of both of the problems. The first problem was we're going to receive $133 in 3 years. Second problem was we're going to receive periodic payments for 3 years. This final problem is a combination of the two. We're going to receive periodic payments for 3 years, and we're going to receive the $133 at the end, which is what we're going to be dealing with in Chapter 7. Even these are easy numbers. We're going to do hard numbers in chapter 7, which is why you want to learn this before we get there. Okay? All right, so we can do that. Our calculator really saves us here. The theory is simply the present value is going to be the present value of 1 plus the present value of the annuity. Okay, so the prior two answers that we got, add them together, and that's the answer. Okay, so conceptually it's actually very easy to do, but our calculator saves us because we can do this in one fell swoop. Okay, so on our calculator, first thing we're going to do is clear all. All right, you'll learn that. Well, actually, we don't cover it that much in here, so you may not learn that in here. But all right, so we clear all. So all we're doing is combining what we just did. All right, so future value is going to be 133. So far, so good. All right, we're receiving, and I'm sorry, I said $100. I meant $50 every 6 months. It's $100 a year. I beg your pardon. Okay, so our payment is going to be $50, and this is where you got to be careful. Okay, make sure that you put these payments in as the same sign, either positive or negative. If you don't, then you're either going to get a wrong answer or you're going to get an error on your calculator. So when you're home replaying this on the video, try that, okay, and see what happens. But for us in this class, I'm not going to get wound up on whether you put it in as a positive or negative because we're just doing a little bit of time value of money. So take your pick. But for ease, I'm just going to put it as a positive, but they have to be the same sign. Okay? Number of compounding periods will be 6. Our rate will be 5% because this 10% is an annual rate. Solve for present value. And if I did it correctly, you should get 353.03. 353.03. Let me do a quick check of that just to make sure. I think I got it. Having trouble reading my notes, but I should be right. So 133 future value, 50 payment, 5 interest, 6 in, 353.03. Okay. Yeah.
You know that it's compounded semi-annually for 6 months?
Compounded semi-annually 6 months. What?
Is the reason that it's compounded is that?
Yes. Yeah, because remember, however frequent the payment is how frequent the compounding is. Okay? It's a good question. So even though I didn't specifically state it, you know that the compounding is semi-annual because the payments are semi-annual. Okay, good question. All right, so make sure you tune into that. All right, the payments are semi-annual. Interest rates always quoted annually, even though I may not say that. And I won't say that. Okay, so because of that, you know that the compounding is semi-annual. Yes, very good question. Yeah. No, I just started off with future value just because that's the order we went. You can put these in any order. Doesn't matter. Doesn't matter. Okay. Other questions? Other questions? Okay, very good. We started that 49 minutes into the tape, so if you want to go back and replay all that, you can do that. I have videos on everything that I just covered. I have interactive spreadsheets for you to practice. I doubt we'll get to long-term liabilities on Tuesday. We should get there on Thursday. So to answer your question, you want to be on top of these simple calculations by Thursday because on Thursday we're going to do some real numbers. Okay? So, all right, great class. Have a good weekend. Watch the hurricane, and I'll see you all next week. Good surf right now, by the way.